China is using gold to replace the US dollar. Imagine waking up one morning and realizing that the basic rules of money, the rules you assumed were permanent, have been quietly rewritten. Not by a committee in Washington, not by a vote in Brussels, but by a government on the other side of the world, buying something as old as civilization itself, gold. For the past few years, China has been doing something that no major power has seriously attempted in modern history. Slowly relinking its currency to physical gold and building an alternative financial system around it. Not a slogan, not a speech. Brick by brick, vault by vault, rule by rule. In simpler terms, China is trying to rebuild how money works. This isn't just a story about gold bugs or obscure central bank policies. It's about the foundation of global power. Who gets to issue the world's money? Who gets to say what it's worth, and who pays the price when that system breaks. Some analysts call this the debasement trade, but that phrase is too small for what is happening. This is a slow-motion attempt to challenge the US dollar's role as the center of gravity in the world economy. And if it succeeds even partially, it could reshape everything from interest rates and commodities to the way wars are fought and alliances are formed. The story first hit mainstream radar through niche podcasts and research reports. One of them, TFTC, laid out the skeleton. But once you connect the dots, China's gold buying, the Shanghai Gold Exchange, new vaults, new corridors, new banking rules, the picture that emerges is something much bigger, a parallel financial system being constructed in real time, one that can lend, trade, and develop without passing through Washington, New York, or the IMF. So let's start with the simplest question of all. Why would the world even look for an alternative to the dollar in the first place? The answer is one word: trust. For decades, after World War II, the US dollar was the closest thing the world had to a financial law of gravity. Around 70% of global foreign exchange reserves, central bank savings accounts were stored in dollars. That usually meant US Treasury bonds, IOUs from the American government, considered the safest asset on earth. If you were a country, you held treasuries because they were stable, liquid, and backed by the world's biggest economy and military. It was less an economic choice and more a default setting of the global system. But trust is fragile. And in 2022, something happened that quietly shattered that trust for a lot of nations. In response to Russia's invasion of Ukraine, the United States and its allies froze roughly $300 billion worth of Russia's foreign reserve. Overnight, the savings of a nuclear power held in the safest assets in the world were turned into numbers on a screen that no longer belonged to them. Regardless of where you stand politically, the signal to the rest of the world was unmistakable. If your reserves are held in dollars, they are not entirely yours. They can be seized. They can be frozen. They can vanish with a policy decision and a few keystrokes. In capitals across the globe, from emerging markets to mid-sized powers, uncomfortable questions started to echo through central bank hallways. If the US can do that to Russia, what happens if we disagree with them next? This wasn't the first time trust in a monetary system was broken. In 1971, when President Nixon ended the direct convertibility of dollars into gold, the world watched the last formal link between money and metal disappear. In 2008, Wall Street's implosion revealed that even AAA assets could be rotten inside. Each time, confidence shook, but the dollar survived. If the US can do that to Russia, what happens if we disagree with them next? Paper claims reserves, bonds, digital balances can be turned off. Gold cannot. Gold cannot be printed. Gold cannot be cancelled in a database. Gold does not default. Slowly at first, then faster. Central banks began tilting away from dollar assets and toward gold. Especially in emerging markets, the countries most exposed to geopolitical pressure. Treasuries were quietly sold. Gold was quietly bought. And no one leaned into that shift harder than China. For years, the People's Bank of China's official gold reserves chart looked sleepy. A bump here, a drop there, but mostly a flat line. It was like watching a heart monitor on someone in a deep, calm sleep. Then the trade war started. Tariffs, threats, accusations, and suddenly that line on the chart jolted upward. China began aggressively, publicly accumulating gold. Month after month, quarter after quarter, it became the largest official buyer of gold on earth, locking metal away in vaults at a pace that modern markets had never seen. They didn't have to do it in public. They could have hidden it through proxies, off-balance sheet entities, or quiet stockpiles, but they chose not to. The message was meant to be seen. Look at how much gold we are buying. We are not chained to treasuries anymore. We don't have to be chained to dollars. And it wasn't just China. Across the world, the dollar's share of global reserves has been sliding to its lowest level in decades, while gold's share has been climbing. Officially, China admits to holding around 2,300 tons of gold. Unofficially, the number is almost certainly higher. Estimates from institutions like Bloomberg Economics, JP Morgan, and the World Gold Council suggest that when you include gold held by Chinese state banks and sovereign funds, gold that doesn't show up in the main central bank ledger, the true figure could be somewhere between 3,500 and 5,000 tons. In other words, China isn't just stacking gold. It is arming itself with monetary ammunition. But gold buying alone doesn't change the system. For decades, gold has mostly been locked away as a dead asset, impressive to look at, comforting to own, but useless in the plumbing of the modern financial world. That is where the story takes a turn, because quietly, in the background, another massive shift has been unfolding, this time not in Beijing or Washington, but in the world of banking regulation. In July 2025, under the Basel III framework, the global rulebook for bank safety gold was officially reclassified as a Tier 1 asset. To most people, that phrase sounds like regulatory jargon. To the people who actually run the financial system, it is a fault line. Under the old rules, gold was a Tier 3 asset. If a bank held, say, $1 billion worth of gold, it could only count roughly half of that value on its balance sheet. It was like owning a skyscraper, but being allowed to pretend you only owned the first 10 floors. The system was essentially designed to keep gold in the shadows. You could store it, you could brag about it, but you couldn't fully use it. Basel III changed that. By upgrading gold to Tier 1 status, regulators allowed banks to recognize 100% of its value. On paper, gold became as solid as cash or treasuries in terms of balance sheet strength. Still, there was a catch. And this is where the story gets really interesting. Even as a Tier 1 asset, gold is not yet treated as a true high-powered financial tool. Banks still cannot widely use it as collateral in the deepest layers of the system, things like repo markets, the short-term loans between financial institutions that quietly keep global finance from seizing up. So, for now, gold is more than a shiny rock, but less than a fully armed monetary weapon. And that in-between status is exactly where China sees an opening. Because the next step above Tier 1 is a different classification altogether. HQLA, high-quality liquid asset. And if gold ever crosses that line, the world's monetary map would change. To understand China's long game, you have to understand one thing. HQLA status is the gateway to power. In today's financial world, the most valuable assets are not those that sit in a vault, but the ones you can borrow against. US Treasuries dominate that space. They are the collateral behind repo markets. They are the scaffolding of global lending. They are the backbone of every major financial institution's liquidity. If you want to build a power plant, develop a port, or stabilize your currency, you need an asset that your central bank can use to borrow. For decades, the United States has controlled that mechanism because its treasuries were the only universally accepted crown jewel collateral. But imagine a world where gold is treated the same way. Imagine a world where a nation can post gold, not dollars, to finance its development. Under that world, countries could borrow, build, trade, and grow without ever touching the US dollar system. And that is exactly the world China is preparing for. The BRICS nations, Brazil, Russia, India, China, and South Africa, have spent years debating alternatives to the dollar. But every attempt ran into the same problem: trust. China would say, use the yuan for global trade. BRICS nations would reply, we might, but what guarantees the yuan's value? China would answer, our economy, our stability, our manufacturing base. The BRICS nations would pause, nod, and then ask the real question, and if we want to convert our yuan into something universal, something physical, where is that gold stored? When the answer was, in China, trust evaporated. No one wanted to repeat the same vulnerability the world had with the US, a single custodian, a single point of failure. But at the latest BRICS summit, China presented a different answer, a new solution, one that addressed the oldest problem in global finance. No nation wants its wealth controlled by someone else's vault. And so China built something unprecedented, a gold corridor. Think of it not as a digital blockchain, but as an ancient physical one. A chain of interconnected vaults across Asia, the Middle East, Africa, and BRICS member states, each linked through the Shanghai Gold Exchange, the largest physical gold marketplace on Earth. Each bar has a serial number. Each bar has purity certification. Each bar is tracked, audited, and verifiable. A distributed international custody system, a gold network, not a gold hoard. For the first time, countries wouldn't just have to trust China. They could see their gold, touch it, redeem it, a physical guarantee for a digital claim. One vault opens in Hong Kong, another in the Middle East, another in Africa, several in BRICS-aligned nations. Each vault becomes a node. Each node becomes a point of trust, and the entire network becomes the backbone of a financial alternative to the West. This breaks the monopoly of the dollar, because when trust is decentralized, the custodian loses the power that comes from control. But China wasn't done solving problems. If gold is to become a modern financial tool, one obstacle remains: volatility. Gold prices swing daily, weekly, too unstable to serve as collateral for major long-term loans. So China proposed the fix: price gold not by its daily market value, but by its moving average. For example, instead of valuing gold at today's spot price, they might average its value over the last 200 trading days. That stabilizes collateral. It removes the risk of sudden price drops. It prevents manipulation by financial giants. It makes gold as predictable as any bond yield curve. In other words, China is engineering gold to behave like a modern financial instrument, not a commodity. And once gold behaves like a stable instrument, it becomes eligible for the same treatment as Treasuries. It becomes a candidate for HQLA status. It becomes a source of global liquidity. This is where the story shifts from interesting to threatening for Washington, because here is the next piece of China's strategy. Use gold-backed yuan financing to build the developing world, especially Africa. Africa is rich in natural resources: gold, cobalt, lithium, rare earths, some of the most energy-rich, resource-rich lands on Earth. But Africa's biggest problem isn't resources, it's infrastructure: roads, ports, grids, railways, the arteries of economic development. For decades, African nations had to go to Western institutions, the IMF, the World Bank, for loans. But those loans came with conditions: political conditions, policy conditions, sometimes destabilizing conditions. China saw an opportunity. Under the new gold corridor, African nations can deposit their gold into SGE-linked vaults. China, through the BRICS New Development Bank, can then lend yuan against that gold. No IMF, No dollar. No Western humiliation ritual of structural adjustment. Just development. Fast. Direct. Collateralized. China finances the project. China builds the roads, bridges, ports, and network. China gains influence. And the developing world gains an escape hatch from the Western financial order. This is how the parallel system is being built. Slowly, silently, strategically. Meanwhile, back in the US, something strange started to happen. A move that seemed small at first, but becomes deeply meaningful once seen through this lens. America began repatriating its gold. For decades, the US held large amounts of gold in foreign vaults, especially in London, partly out of convenience, partly out of tradition. But this year, something changed. Shipments of US owned gold quietly began returning home. Washington's official explanation was vague tariff adjustments, audit concerns, logistics. But the timing made analysts suspicious. Slowly, silently, strategically, viewed through this new global battle over gold, the answer becomes obvious. If the world is shifting toward a collateral system where physical gold matters, then gold stored overseas is a liability. Because possession is power, custody is control, vault location is leverage. The US watched China expand its vault network across Asia, Africa, and the Middle East. And it responded with the only logical move: bring home the gold, control it directly, prepare for a world where gold must move physically, not digitally, to settle claims. The US officially holds around 8,000 tons of gold, still the largest stockpile in the world. But that stockpile matters far more in a world where gold is collateral than in a world where gold is symbolic. Two empires, one aging, one rising, quietly fortifying their monetary arsenals. Not with aircraft carriers, not with missiles, but with bars of yellow metal, because if gold becomes a high-quality liquid asset, the one who controls the gold controls the future of global credit. And the fight for that future has already begun. Now comes the question that everyone eventually asks. If all of this is true, if nations are rearranging their monetary foundations, what does it mean for the price of gold? For financial markets? For investors? For the future of money itself? To answer that, we need to zoom out and examine the balance sheets of the world. Right now, most central banks, sovereign wealth funds, and major financial institutions keep around 20% of their reserves in gold or equivalent hard assets. It's a comfortable baseline enough to hedge against instability, not enough to challenge the dollar. But new guidelines and internal research notes from major institutions, Bank of America among them, are suggesting something extraordinary. The appropriate reserve allocation for gold may need to rise to 30%. A 10% shift doesn't sound dramatic on paper, but across the entire global financial system, that 10% represents something close to $2 trillion of new demand for gold. And unlike the dollar, gold cannot be printed. It cannot be conjured. It cannot be expanded by policy. When $2 trillion of new demand enters a market with fixed supply and limited annual production, basic economics takes over. Prices rise violently, inevitably. Some analysts whisper predictions of gold doubling within the next 5 years, not because of hype, not because of fear, but because of structural demand created by nations, not traders. A shift in the architecture of global finance itself. But gold is only half the story. To understand the other half, we need to look at a different kind of asset, one born not from the earth, but from code. A shift in the architecture of global finance itself. What does this geopolitical chessboard mean for it? For years, Bitcoin's price behavior confused traditional analysts. It moved in cycles, it reacted to liquidity, but it often seemed suppressed, held down by forces invisible to retail traders. But when viewed through the lens of global monetary strategy, something becomes clear. If you were a nation, whether the US, China, or a rising BRICS power, and you were quietly evaluating both gold and Bitcoin as monetary tools, why on earth would you want either asset to skyrocket before you accumulated enough of it? You wouldn't. You would want time. You would want accumulation. You would want silence. Only after you've secured your position would you let the market run. This is why the world now seems to be splitting into two monetary visions, two competing philosophies of trust. China's vision, a world where money is backed by something ancient, physical, immovable, gold as stability, gold as collateral, gold as the anchor of international development. The US vision, a world where trust comes from transparency, speed, programmability, a world where digital assets, tokenized treasuries, stablecoins, and perhaps even Bitcoin become the new tools of influence. If China pairs its currency with gold, the US may be forced to pair its financial system with something digital, something that plays to its technological strengths, not its weakening monetary dominance. Gold represents trust through time. Bitcoin represents trust through energy and math. Two different answers to the same question. What should money be after the dollar? For the first time in modern history, global powers are being forced to compete for that answer. In the 20th century, there was only one standard, the British pound, then the US dollar. But the 21st century may not have a single global reserve currency. It may have two competing systems, a gold-backed BRICS world led by China, slow, physical, collateral-rich, development-focused, a digital West led by the United States, fast, open, programmable, aligned with technology and markets, and both systems could function side by side. Two gravitational centers, two monetary philosophies, two paths to global influence. If that happens, asset prices, especially gold and Bitcoin, will not rise slowly. They will reprice rapidly, violently, across a span of months or even weeks, but not today, not this year, because these transformations move on decade-long timelines, 5 years, 10 years, sometimes longer. But once the shift begins, it can accelerate faster than anyone expects. The way the gold window closed in 1971, or the way the 2008 crisis detonated in a single autumn, or the way sanctions reshaped 2022 overnight. Money systems change slowly until the day they change suddenly. This is the world we are walking into, a multi-monetary landscape, a contest of ideas, not just armies, a struggle for trust, not just territory. China building a hard, physical monetary spine through gold. The US building a digital open monetary architecture through technology. Maybe they clash, maybe they coexist, maybe they merge. But one thing is certain, the era of a single, uncontested global reserve currency is ending. And in its place, a new monetary age is rising, one defined by competition, complexity, and choice. The question is not which system will win. The question is which system you are prepared for.